Position sizing made simple, the secret that keeps professional traders alive. Imagine two traders, both have the exact same strategy, both identify the exact same setup, both enter at the exact same price. The trade loses. One trader barely notices the loss, the other loses half of his account. What made the difference? It wasn't experience, it wasn't intelligence, it wasn't the market, it was one decision: how much to risk. This single decision determines whether you survive long enough to become consistently profitable or whether you join the thousands of traders who disappear after blowing account after account. Today, we're breaking down position sizing in the simplest way possible. No complicated formulas, no confusing mathematics, just practical risk management that professional traders rely on every single day. Because the truth is, great traders don't survive because they predict the market better. They survive because they know exactly how much they're willing to lose before they ever think about how much they might make. Welcome to the Trading Jagaban. If you're serious about becoming a disciplined trader instead of another gambling statistic, subscribe and turn on notifications. Let's begin. Introduction. One of the biggest lies beginners believe is this: if my strategy is good enough, risk management doesn't matter. It sounds reasonable. After all, if you're winning most of your trades, why worry about losses? But here's what professionals understand. Every strategy loses. Even the best hedge funds in the world experience losing trades. Even traders who've been profitable for 20 years have losing weeks. Losses are not the exception. Losses are part of the business. The question isn't whether you'll lose. The question is, how much will you lose when you're wrong? That's where position sizing comes in. Unfortunately, this is one of the most ignored topics in trading. Most beginners spend hundreds of hours searching for the perfect indicator, the perfect entry, the perfect confirmation, the perfect strategy. Yet they spend almost no time learning how much money to put on each trade. Ironically, that's the decision that determines whether they stay in the game. What is position sizing? Let's remove all the complicated language. Position sizing simply means how big your trade should be. That's it. Not where you enter, not where you exit, not your stop loss, not your take profit. Simply, how many lots, how many contracts, how many shares, how much exposure. Every single trade answers one question: how much money am I putting at risk? Professional traders answer this question before entering. Beginners answer it emotionally after entering. That's the difference. Why position size matters more than entries. Imagine two drivers. One drives carefully, the other drives recklessly. Now imagine both eventually make a mistake. Who survives? Usually, the one who prepared for mistakes. Trading works exactly the same way. Professional traders don't assume they'll always be right. They prepare for being wrong. That's why position sizing is more important than having perfect entries, because even perfect entries fail, markets change, news happens, liquidity disappears, unexpected volatility occurs. Nobody controls that, but everyone controls their position size. Practical example. Let's imagine two traders. Trader A has a $10,000 account. Trader B also has a $10,000 account. Both find the exact same trade. Both risk different amounts. Trader A risks 20%. Trader B risks 1%. The trade loses. Trader A loses $2,000. Trader B loses only $100. Now another losing trade happens. Trader A now has $8,000. Trader B has $9,900. Another loss. Trader A now has $6,400. Trader B still has $9,801. Notice something. Neither trader has a better strategy. Neither trader is smarter. Neither predicted the market correctly. The only difference: one understood position sizing. The hidden danger of big positions. Many beginners think like this: if I trade bigger, I'll recover faster. This sounds logical, it feels aggressive, it feels confident, but mathematically, it's one of the fastest ways to destroy an account. Here's why. Large positions make normal market movements feel catastrophic. A small pullback suddenly feels enormous. Minor fluctuations create panic. The trader starts moving stop losses, closing trades early, removing stop losses completely, revenge trading, adding more positions. Everything becomes emotional, not because the market changed, because the position size was too large. Think about this. Have you ever entered a trade, then found yourself staring at every candle, checking your phone every 2 minutes, feeling anxious, unable to sleep? There's a good chance your position size was too big. Professionals understand something beginners don't. Emotions don't always come from losing, they come from risking too much. If one trade can ruin your week, you're oversized. If one trade can ruin your month, you're oversized. If one trade can destroy your account, you're gambling. Beginner versus professional mindset. Let's compare them. Beginner, I need this trade to win. Professional, I don't need any single trade. Beginner, I'll double my lot size. Professional, I'll keep risking the same percentage. Beginner, I've lost 3 trades. This next one must be bigger. Professional, my rules don't change because of emotions. Beginner, I'll recover everything today. Professional, my job is staying in business. Notice the pattern. Professionals think about survival. Beginners think about excitement. Why survival is the real goal. Imagine owning a restaurant. Would you spend half your savings every day hoping customers arrive? Of course not. You manage expenses carefully because you know tomorrow matters. Trading is no different. Your account is your business. Every trade is an expense. Some expenses produce profit, others don't. The business survives because losses are controlled, not because every decision succeeds. Professional traders understand that survival creates opportunity. Debt accounts cannot recover. The myth of getting rich. Quick social media has convinced many traders that success comes from massive gains, turning $100 into $10,000, making 500% in 1 week, doubling accounts overnight. Those stories attract millions of views, but they rarely tell you what happened afterward. Many of those traders eventually lost everything, because the same risk that creates extraordinary gains also creates extraordinary losses. Professionals don't chase extraordinary months. They build extraordinary careers. Careers are built through consistency, not luck. Understanding risk per trade. Here's one of the most important concepts you'll ever learn. Professional traders don't think in dollars first, they think in percentages. Why? Because percentages grow with the account. Suppose you decide to risk 1% per trade. If your account grows, your position naturally becomes larger. If your account shrinks, your position naturally becomes smaller. This creates automatic protection. Your risk adjusts with reality. That's how professionals survive difficult periods. Why consistency beats intensity. Imagine 2 athletes. One trains every day for 5 years. The other trains intensely for 1 week, then quits. Who becomes stronger? Consistency always wins. Trading follows exactly the same principle. You don't need spectacular months. You need sustainable months. Position sizing makes sustainability possible. Without it, even a good strategy eventually collapses under emotional pressure. If you've learned one thing from this video today, hit the like button, make sure to subscribe to the Trading Jagaban channel, and don't forget to leave a comment below. Thanks for watching. Watch this next.